Welcome, welcome, welcome to another deep dive. Many of us often approach these big life decisions, like buying a home, with a certain set of assumptions. We sort of imagine a process that, yeah, it's complex, but it follows a pretty familiar roadmap. But what if that roadmap has, like, hidden detours, especially when you get to the money part? Today, we're going to pull back the curtain on a topic that often surprises even savvy buyers, the really nuanced world of condo financing. You might think getting a mortgage for a condo is, well, pretty much identical to getting one for a single-family house, right? But trust me, there are some surprising twists and turns, and these can fundamentally alter your home buying journey, really from the moment you apply for that loan all the way through to the monthly payments you end up making. Our mission today is to really embark on a true deep dive into these distinctions, meticulously exploring what sets condo financing apart. Our foundation for this exploration comes from some really insightful excerpts from Condo versus Home Financing, Key Differences, a source that honestly drills down into these often overlooked details. Our goal isn't just to skim the surface or, give you a basic rundown. No. It's to extract the most important nuggets of knowledge, those genuine aha moments that will genuinely empower you, our listener, to navigate this complex process with confidence. By the end of this deep dive, you should feel not just informed, but truly prepared to make smart decisions if, maybe, a condo is in your future.
It's fascinating, isn't it, how processes that seem so similar, like, getting a mortgage for a property can diverge so significantly the moment you look at a condominium instead of a standalone home. We'll be looking not just at what these differences are on paper, but critically why they exist in the first place and what profound, often unexpected implications they hold for anyone considering a condo, whether it's for their next home or maybe as an investment. The core of it really lies in the fact that lenders apply a much broader lens when they're evaluating a condo loan. It really extends well beyond just your individual financial health, your credit score, your income. They're actually assessing the entire building's health, its community dynamics, its collective financial solvency, and yeah, its long-term viability. They sort of treat the condo complex almost as a single collective entity that your individual unit is just, well, inextricably linked to. And this holistic evaluation, this paradigm shift in risk assessment, is precisely where the complexity truly begins.
That's a crucial point, and it sets the stage perfectly for where we'll begin. Because when you're buying a single-family home, the lender's focus is almost entirely on your financial report card, right? They're scrutinizing your credit score, your income, your debt-to-income ratio DTI, and, of course, the size of your down payment. It's a very personal assessment. It's centered on your individual ability to repay that loan and the value of that specific property you're offering as collateral. But with a condo, wow, the spotlight widens dramatically. It's not just about your ability to pay, it's about the financial health and stability of an entire community that you're about to join. So what exactly else do lenders scrutinize when it comes to condos? Things they typically wouldn't even glance at for a standalone house. What's under that broader lens?
This is really the core differentiator, yeah. And it's absolutely critical for prospective condo buyers to grasp this. Lenders, in essence, view a condo purchase as an investment not just in a specific unit, like the four walls you own, but in a share of a larger collective enterprise, the condo association and the building it manages. This means they delve into several layers of due diligence that simply don't apply to single-family homes. Think of it as a deep dive into the very ecosystem your unit exists within. So, first and foremost, they scrutinize the financial health of the condo association itself and the building. And this isn't just a quick glance, it's an in-depth, almost forensic analysis. Why is this so crucial? Well, because shared ownership fundamentally means shared risk. The condo association is the entity responsible for pretty much everything outside your unit's walls. We're talking common areas like hallways, lobbies, maybe a fitness center, pools, the roof, the exterior walls, and critical infrastructure like elevators, plumbing risers, HVAC systems for those common areas. You name it. If this association is financially unstable, it directly impacts the value and, frankly, the habitability of every single individual unit within that complex. For instance, lenders will meticulously review the association's balance sheets, their income statements, their annual budgets. They'll look closely at the delinquency rates of current owners, like how many people are behind on their HOA fees.
Oh, wow. Okay.
Yeah, a high delinquency rate is a major red flag. It indicates potential financial strain for the whole association. They also want to see if the association has a history of operating deficits, or maybe if their budget just seems artificially low, which could signal trouble down the road. Imagine this scenario. The association has critically low financial reserves, maybe no clear budget for capital improvements, and suddenly, bang, a major unexpected repair is needed.
Like the roof needs replacing or something major.
Exactly. Or the entire plumbing system for a whole stack of units needs an overhaul because of widespread leaks. Who bears that financial burden?
The owners, right.
Yep.
Through special assessments.
It falls directly on the unit owners, often through really burdensome special assessments. This directly impacts your personal finances and, by extension, the lender's collateral, which is your unit. Poor association management, chronic financial struggles, or a history of deferred maintenance can lead to a deteriorating property, or even, in extreme cases, foreclosure issues that ripple through the entire complex, affecting every unit holder, regardless of their individual financial standing. This naturally makes lenders very, very nervous because it compromises the long-term desirability, marketability, and resale value of a unit. It creates a ripple effect that extends far beyond your individual ownership. They want to ensure their investment, your unit, and the loan they provide is in a stable environment. Another absolutely critical factor lenders assess is the percentage of owner-occupied units versus investor-owned rentals within the complex.
That seems more about the feel of the place, but you're saying it's financial.
It has profound financial and rhythm implications, yes. Generally, a higher percentage of owner occupancy indicates a more stable, well-maintained community. Residents who actually live in their units are typically more invested, in the long-term health, appearance, and value of the property. They show up to association meetings, maybe volunteer for committees. They're more likely to report issues promptly and often take greater pride in the common areas. They're also generally less likely to default on their HOA fees or mortgage payments.
Makes sense. They
Yeah.
live there.
Exactly. Conversely, complexes with a large proportion of investor-owned units, especially if they're transient rentals, can sometimes imply higher tenant turnover, maybe less community engagement, and in some cases, potentially more wear and tear if those units aren't actively managed and maintained by absentee landlords. Lenders perceive a higher risk with a large proportion of rentals for several reasons. They tend to have higher default rates historically, can lead to higher insurance premiums for the building, and may indicate a less stable community where common area maintenance might be neglected. For instance, Fannie Mae, a huge player in the conventional loan market, often requires owner occupancy rates of 50% or higher for certain types of financing.
50%, that's quite a high bar.
It can be. If a complex falls below that threshold, obtaining conventional loans can become significantly harder, maybe even impossible in some cases. So for you, this means understanding the community's makeup isn't just about finding good neighbors, though that's nice too. It's a profound financial due diligence step that directly impacts the lender's willingness to underwrite your loan and the terms they might offer. And closely related to the association's overall financial health are the financial reserves of the Condo Association.
Right, you mentioned those before, the emergency fund for the building.
Precisely. This refers to the cash reserves the association holds specifically for future capital expenditures and, well, emergencies. This is a crucial indicator of the association's ability to cover unexpected expenses or major capital improvements, like replacing an aging HVAC system, repaving parking lots, or updating common amenities, without resorting to those burdensome special assessments we just discussed. Lenders don't just want to see some reserves. They often look for what's considered adequate. This might mean reserves that represent a significant percentage of the annual budget, or, more rigorously, that the reserve study shows a healthy percentage of funding, often 70% or more funded.
A reserve study, what's that exactly?
Good question. A reserve study is a professional assessment. It looks at the building's major components, roof, elevators, plumbing, things like that, their remaining useful life, and the estimated cost to repair or replace them. It then outlines a funding plan to ensure the association has the necessary cash set aside over time. If this fund is depleted or just insufficient, any major repair, be it a failing roof, an outdated elevator system, or a burst main plumbing line, will fall directly on the unit owners through significant, often unexpected assessments. A common trap for buyers, unfortunately, is when associations strategically underfund reserves to keep the monthly HOA fees artificially low.
To make the units look more affordable up front.
Exactly. It can attract buyers, but it almost guarantees massive, sudden special assessments down the line when major repairs become unavoidable. Strong, adequately funded reserves signal financial stability and responsible management to a lender, significantly reducing their perception of risk. They want to ensure the building can sustain itself without constantly burdening its residents. The level of these reserves directly impacts a lender's risk assessment. It's a key metric for long-term planning and fiscal prudence. Furthermore, lenders meticulously investigate any pending litigation involving the condo complex.
Oof, yeah, lawsuits are like a huge red flag.
They are, for obvious reasons. Litigation, especially cases concerning significant construction defects, allegations of financial mismanagement, or major disputes within the association can pose immense financial risk. These lawsuits can tie up substantial association funds, lead to astronomical legal fees, and, most critically, they can significantly devalue individual units by casting this cloud of uncertainty over the property. Imagine a major lawsuit over a pervasive leaky roof, maybe severe structural issues, or even a dispute with the original developer that could mean millions of dollars in potential liabilities for the association. This directly impacts its ability to maintain the property or its long-term financial viability. Lenders are particularly wary of construction defect litigation, as it can indicate inherent flaws in the building itself, making their collateral less secure. Even if the lawsuit isn't directly related to construction, any significant legal action that could lead to large financial payouts by the association, and therefore potentially special assessments for unit owners, will raise serious concerns. This raises an important question for you, the prospective buyer. Have you considered what potential legal battles could mean for your investment? It's not just about the present enjoyment of the unit, it's about avoiding future headaches and protecting your financial stake. A pending lawsuit can sometimes halt lending for an entire complex, making it virtually impossible to secure a mortgage until the issue is fully resolved. And finally, just to round this section out, lenders will check the FHA or VA approval status of the association if those government-backed loan types are being considered.
Right, for specific loan programs.
Exactly. This might seem like just an administrative detail, but it's a pass-fail requirement for these specific loan programs. These agencies, FHA and VA, have really stringent guidelines for condo projects. These often relate directly to owner occupancy rates, the overall financial health of the association we've been discussing, and even the construction quality of the building. It's all designed to protect both the borrower and ultimately the taxpayer funding those programs. For example, FHA has specific rules regarding the percentage of commercial space within a condo development, the number of units owned by a single entity, and prohibitions on certain types of recreational leases. If the condo complex isn't on their approved list, or if its approval has lapsed, those particular loan options are simply off the table. Full stop.
So it doesn't matter how good my credit is.
It doesn't matter how stellar your personal credit profile might be, or how much you love the unit. If the building isn't FHA or VA approved, you can't get that specific type of loan for it. This rigorous approval process ensures that the project meets FHA's and VA's minimum standards for financial stability, a healthy owner occupancy rate, and sound structural integrity. Many older or smaller condo projects, for example, might never have gone through or maybe couldn't pass the approval process. This immediately narrows the financing options for prospective buyers who might rely on these loans for their lower down payment requirements or specific veteran benefits. And this often brings us nicely to our next point: loan program eligibility itself.
Okay, so if a lender is already putting the entire condo association under this microscope, what does that mean for the specific type of loan I, the individual buyer, can actually get? It sounds like my options might be far more limited, or at least more specifically defined, than I'd initially assume when looking at a condo. You can't just assume every traditional mortgage program available for a single-family home will be equally accessible for a condo. It's almost like trying to fit a square peg in a round hole. Not all mortgage programs are designed to accommodate the unique shared ownership structure of condo living without imposing a series of extra checks and balances. This brings us to a really crucial point about navigating the various loan programs available.
Exactly. The eligibility criteria for different loan types become a significant hurdle specifically for condos. Let's delve into some common loan types. For instance, let's talk about FHA loans. The core requirement here is absolute. The condo complex must be on the FHA-approved list. And I cannot stress enough the strictness of this list. The Federal Housing Administration maintains a publicly accessible database of approved condo projects across the country. If a complex isn't on that list, or maybe its approval has lapsed, FHA financing is simply not an option, full stop.
No wiggle room at all.
None. It doesn't matter how perfect your credit score is or how much you love the unit. If the building isn't FHA approved, you cannot get an FHA loan for it. This rigorous approval process ensures the project meets FHA's minimum standards for financial stability, a healthy owner occupancy rate, typically requiring at least 50% owner occupancy, and sound structural integrity. It's all designed to protect both the borrower and the FHA insurance fund. Common reasons for non-approval or maybe removal from the list include high commercial space ratios. FHA usually limits commercial space to 35% or less of the total square footage, too many non-owner occupied units, significant pending litigation, or insufficient reserves. We've touched on these.
Right, all the things we just talked about.
Exactly. Many older, smaller, or mixed-use condo projects, for example, might never have gone through or may not have been able to pass the FHA approval process. This immediately narrows the financing options for prospective buyers who might rely on an FHA loan for its attractive, lower down payment requirements, which can be as low as 3.5%. So for you, this is a critical early check. Before you even fall in love with a unit and start imagining your life there, you absolutely need to verify if the complex is FHA approved, if that's your intended financing route.
Definitely saves potential heartache later.
Immense time and heartbreak, absolutely. Similarly, for VA loans, the condo development must also be VA approved. The Department of Veterans Affairs has its own set of stringent standards for condo complexes. They often mirror FHA's in terms of evaluating the project's financial health, structural viability, and owner occupancy rates, but they're tailored specifically to protect veterans using their hard-earned benefits. The VA approval process for condo development can be just as rigorous, sometimes even more so, than FHA.
And the reasons for not being approved are probably similar too.
Very similar. As we touched on earlier, it often comes down to factors like too many investor-owned rental units, insufficient financial reserves to cover future repairs, certain types of problematic recreational leases, or active pending litigation against the complex. Any of these issues can cause a condo project to fail to meet the strict guidelines set by these agencies, thereby rendering it ineligible for their respective loan programs. It's worth noting that if an FHA or VA loan is critical to your purchase, maybe because of the specific benefits they offer and the condo you like is not approved, your only option might be to look for a different complex entirely. Then we come to conventional loans, the ones backed by giants like Fannie Mae and Freddie Mac. These make up the vast majority of mortgage originations.
Okay, so maybe more flexibility here.
Often, yes, more flexible than FHA or VA loans. But even here, some condos may require what's known as a full project review. This means the condo association must meet strict guidelines set by Fannie Mae or Freddie Mac themselves to be considered warrantable.
Warrantable. Okay, what does that involve?
A full project review is precisely what it sounds like. An extensive deep dive into every aspect of the condo's operation. This includes scrutinizing the condo's financials in meticulous detail, its budget, reserve study, delinquency rates. They generally prefer less than 15% of units delinquent on HOA fees. Whether a single entity owns more than a certain percentage of units, often capped at 10% for conventional loans, its legal standing, no significant litigation, its insurance policies, and even its physical condition and maintenance records.
Wow, that sounds exhaustive.
It is. This exhaustive review is designed to protect the secondary mortgage market, ensuring that the loans they purchase are secured by financially sound and well-managed properties. Now, this is in contrast to a limited review or sometimes even a no-review option, which might be available for less risky or well-established projects that meet certain criteria, like having a high owner occupancy rate, ample reserves, and no major red flags. But a full review adds considerable complexity and time to the loan approval process. It requires a significant amount of documentation from the condo association itself, which frankly can sometimes be difficult or slow to obtain.
So these guidelines probably push associations to manage things better.
They certainly encourage better financial management, proactive maintenance, and adherence to specific ownership ratios and commercial space limits, yes. Because the ability to secure conventional financing is crucial for marketability and unit sales in the vast majority of cases. If a condo project isn't warrantable, it dramatically limits the pool of potential buyers who rely on conventional loans, and the consequences of noncompliance with any of these requirements are significant for you, the borrower. If a condo doesn't meet these stringent guidelines, whether it's FHA approval or the specific conventional project review standards, borrowers might find themselves in a real bind. They might need to seek alternative financing. This often translates to non-conforming loans or portfolio loans from smaller local banks or credit unions.
And those usually aren't as good, terms-wise.
Typically, no. These alternative loans usually come with less favorable terms, like higher interest rates, stricter qualification criteria, or maybe shorter repayment periods. That's because they aren't backed by the government or the secondary mortgage market giants, meaning the local lender holds all the risk. Alternatively, the lender might simply demand a substantially larger down payment.
More skin in the game reduces their risk.
Exactly. A larger down payment significantly reduces the lender's risk exposure, sometimes making a previously unwarrantable condo fundable. For example, instead of a standard 3-5% down payment with an FHA or conventional loan, you might be required to put down 20%, 25%, maybe even more, sometimes up to 50% for particularly risky projects.
50% down, that's huge.
That's a massive difference. For a $400,000 condo, this could mean needing to bring $80,000 to $100,000, even $200,000 for your down payment, which is a significant jump compared to, say, $12,000 to $20,000 for a single-family home with a lower down payment option. This really highlights the importance of thorough research upfront. Knowing these potential hurdles can save you immense time, effort, and yeah, even heartbreak later in the process, especially after you've already invested emotionally in a particular unit. You literally need to understand the building's financial profile before you even seriously consider making an offer.
Okay, it's abundantly clear that just the path to approval for a condo mortgage is already far more intricate than for a single-family home.
Wow.
But the differences don't stop there, do they? Beyond the approval process, there are tangible cost differences that directly impact your wallet. We're talking about your initial investment and your ongoing monthly expenses. It's not just about the sticker price of the unit, it's about the entire financial ecosystem you're stepping into. So if you considered how a condo's shared ownership structure might actually affect your mortgage interest rate, or the size of your initial investment compared to buying a house, these are costs that can truly add up over time.
Absolutely. The financial distinctions for condos are definitely multifaceted and can indeed have a significant impact on your overall costs, often beyond what people initially expect. Let's break down some of these crucial monetary implications that, well, directly hit your wallet. First, let's talk about higher interest rates. It's actually not uncommon for lenders to charge slightly higher interest rates for condo loans compared to single-family homes.
Really? Why is that? Is it just risk?
It boils down to what lenders perceive as the perceived risk of shared ownership. Yes, risk. This risk stems directly from all those factors we just discussed. The reliance on the condo association's financial health, the potential for unexpected special assessments, and the collective nature of the property. Issues affecting one part of the building or one set of owners can quickly impact all units. If the association fails, or if a major problem arises that isn't adequately covered by reserves or insurance, it affects all units and, by extension, the lender's collateral. Lenders price this additional layer of risk into the interest rate. This risk premium can indeed vary based on broader market conditions and, very importantly, on the specific condo project's perceived stability and compliance with lender guidelines. A meticulously managed, well-funded condo with a high owner occupancy rate might see a smaller premium, while a riskier project, maybe one with high renter concentration or a history of litigation, could face a larger one, sometimes up to a quarter or even half a percentage point higher.
A quarter point doesn't sound like much, but I guess it adds up.
It really does. Even a seemingly small difference, say a quarter-point difference in interest rate over a 30-year mortgage, can add up to tens of thousands of dollars over the life of a loan. For instance, on a $300,000 mortgage at 7% versus 7.25%, that seemingly small increment could mean an extra $12,000 to $15,000 in interest paid over 30 years. That significantly increases your total cost of ownership. It's a sort of hidden cost of shared risk. Next, there's the very real possibility of a higher down payment. Condos often require a larger down payment, especially if the condo project is not considered warrantable by those Fannie Mae or Freddie Mac standards, or if it doesn't meet FHBO approval. A warrantable condo is essentially one that has been vetted and approved, implying a lower perceived risk for lenders. If a project is deemed non-warrantable, meaning it doesn't meet those conventional standards due to issues like too much commercial space, a high percentage of investor-owned units or pending litigation lenders demand more equity from the buyer to offset that increased risk.
Right. Back to the 25% or more.
Often, yes. It frequently translates into a requirement for a 25% down payment, sometimes even more, instead of the lower 3-5% or maybe 10% down payments typically seen on conventional single-family home loans. So again, using that $400,000 condo example, if it's non-warrantable, this could mean needing to bring $80,000 to $100,000 for your down payment. That's a significant jump compared to, say, $12,000 to $20,000 for a similar price single-family home with a lower down payment option. This is a critical point for your financial planning. Do not assume the same down payment strategy you'd use for a house will apply to every condo.
Definitely need to check that warrantability status early.
Absolutely. You need to be prepared for the possibility of needing significantly more cash up front, which can be a substantial hurdle for many buyers, especially first-time buyers. Then we have homeowners association, HOA fees. When financing a condo, lenders factor these recurring fees directly into your debt-to-income DTI ratio.
And these are usually higher for condos than houses, right?
Generally, yes, and they are almost always mandatory in condos. Unlike single-family homes, where HOA fees, if they even exist, are often less common or less substantial, condo HOA fees can be quite considerable. These fees typically cover common area maintenance like landscaping, cleaning of common spaces, amenities like a pool, gym, or clubhouse, sometimes even certain utilities like water or trash pickup, and a portion goes into the association's reserve fund for future capital expenditures. Lenders view these fees as a fixed, recurring debt obligation, much like a car payment, student loan payment, or a credit card bill. This directly impacts how much mortgage you can qualify for.
So it reduces my borrowing power.
Precisely. For instance, if your maximum allowable DTI is, say, 43% and your HOA fee is $500 per month, that $500 reduces the amount you have available for your principal, interest, property taxes, and homeowners insurance, your PITI. It essentially shrinks your borrowing capacity for the mortgage itself, even if your personal income and credit are strong. For example, if you were approved for a $350,000 mortgage on a house, that same income might only qualify you for a $300,000 mortgage on a condo with a substantial HOA fee. This raises an important question. Have you accurately factored these recurring fees into your affordability calculations? They are not an optional expense and can significantly limit the loan amount you qualify for, altering what price range of units you can realistically consider. And finally, let's discuss special assessments. These are those extra fees charged to condo owners, typically as a lump sum payment or maybe a temporary increase in HOA fees when the association needs significant funds beyond its normal operating budget.
Right, for the big unexpected repairs.
Or sometimes planned ones, but often unexpected. It could be for a new roof, extensive structural repairs, major landscaping overhauls, or even the settlement of a large lawsuit. Lenders are particularly wary of special assessments because they represent an unforeseen and potentially substantial financial burden on the borrower. They can also be a significant indicator of underlying issues with the building itself or with the association's past financial management, perhaps a history of underfunding reserves or deferring critical maintenance. There are generally two types. Planned assessments, which might be for a known upcoming major renovation, like replacing all the windows, and unexpected assessments, typically triggered by an emergency like storm damage, a sudden catastrophic plumbing failure, or a large lawsuit settlement.
Lenders probably hate the unexpected ones more.
Absolutely. While planned assessments can sometimes be factored into a lender's review, unexpected ones are a major red flag. If the building is currently undergoing major renovations that necessitate large special assessments, or if it's facing significant financial difficulties that have led to them, lenders may be hesitant. They might even outright refuse to approve the loan due to the perceived instability and the increased, unpredictable financial burden on the buyer.
So how do they judge them? Is there a tipping point?
Well, they typically want to know the reason for the assessment, the total amount, how it will be paid, lump sum versus installments, and critically, whether it suggests deeper systemic problems with the building or its finances. A very large assessment, or a continuous stream of them, can definitely be a tipping point for loan denial. It signals a high risk to the lender's collateral and the borrower's ability to manage their financial obligations. It's a warning sign that the association might not be fiscally sound.
That's a truly comprehensive look at the direct monetary implications. Wow, often far more complex and substantial than buyers might initially realize. Okay, let's shift our focus now to an often overlooked but absolutely crucial aspect of condo ownership and financing. Insurance. Because when it comes to condos, the way you protect your property takes on a completely different sort of multi-layered form. It's not just about what you cover, it's about what the association covers, and precisely where those two responsibilities intersect, or critically, where they might leave gaps. Do you know exactly what your condo insurance would cover versus what the association is responsible for? It's a distinction that can literally save you thousands if disaster strikes.
That's an excellent point. Property insurance is fundamentally different for condos, and understanding it is key. To understand it, let's first establish the baseline with single-family home insurance. For a standalone house, buyers purchase an individual homeowner's insurance policy, typically an HO3 policy, which is pretty comprehensive. This policy is designed to cover the entire property and its structure, meaning the physical dwelling itself from the foundation up to the roof, any detached structures like garages or sheds, your personal property within the home, and it provides liability coverage for incidents that occur on your property. The homeowner is solely and entirely responsible for ensuring the whole physical asset. If a pipe bursts, causing damage to your walls and personal belongings, your HO3 covers it all, generally speaking. Now, compare that to condo insurance. This involves both an HO6 policy for your unit and the condo association's master policy for the building and common areas.
Okay, so two policies working together.
Exactly. This is where the multi-layered approach comes in. The condo association carries what's called a master policy, and it's essential to understand that there are different types of master policies, each defining the extent of the association's coverage. First, there's the bare walls in or studs out policy. This is the most limited type. It covers the main structure of the building, its exterior and common areas, but nothing inside your individual unit beyond the structural elements, like the drywall itself might not even be covered. It doesn't cover your interior walls, flooring, cabinetry, or fixtures.
So I'd need my own insurance for almost everything inside.
Pretty much everything finished inside your unit, yes. Then there's the original specifications, or single entity policy. This type covers the building's main structure, common areas, and also includes the interior walls, fixtures, and standard finishes like basic countertops or flooring, as they were originally installed by the developer. Any upgrades you make beyond those original specs would not be covered by the master policy. And finally, there's the all-in, or all-inclusive policy. This is the most comprehensive master policy. It covers the building's main structure, common areas, and everything inside your individual unit, including any improvements or upgrades you've made up to the point of a major loss.
Knowing which type the association has seems critical then.
Absolutely vital. Regardless of the type, the association's master policy covers the building's main structure, its exterior, all common areas like hallways, lobbies, fitness centers, elevators, the roof, and shared amenities. It also provides liability coverage for the association itself. This master policy is absolutely crucial because it protects the core asset, the building in which your unit resides. Lenders must verify that this master policy is adequate and up to date before approving your loan, as it protects their collateral, the entire building. They'll want proof of sufficient coverage for the replacement value of the structure and adequate liability limits. Your responsibility as a condo owner then typically requires you to purchase an HO6 insurance policy, sometimes referred to as walls-in coverage, though that term can be misleading depending on the master policy. This HO6 policy picks up precisely where the master policy leaves off. If the master policy is bare walls in, your HO6 will need to be very robust. It needs to cover everything from your interior walls, flooring, and cabinetry to your personal property, furniture, electronics, clothing, fixtures, and appliances. If the master policy is original specifications, your HO funds would primarily cover your personal property and any upgrades you made beyond those original finishes. And if the master policy is all in, your HO6 might be primarily focused on just your personal property and personal liability, as the structure itself is largely covered by the master policy.
So you really need to read the master policy documents.
You absolutely do, or have your insurance agent review them carefully to avoid dangerous coverage gaps. Your HO6 also provides liability coverage for incidents that occur within your unit. To illustrate this, imagine a fire starts in a common hallway outside your door. The association's master policy would cover the damage to that common hallway, the building structure, and potentially any damage to the exterior. But if that fire then spreads into your unit, your HO6 policy would cover the damage to your interior walls, your personal belongings, and any other fixtures or improvements within your specific unit. This distinction is critical for you to understand what you are truly insuring. Now, what happens if the master policy isn't adequate? This is a critical question with potentially serious financial ramifications.
Leads back to special assessments, I bet.
Exactly. If the master policy has insufficient coverage for a major loss, say a hurricane causes massive damage exceeding the policy limits, it could absolutely lead to a special assessment levied against all unit owners to cover the shortfall. This is precisely why lenders meticulously perform verification of the master policy. It's a non-negotiable step in the loan approval process. Lenders need to ensure their collateral, the building itself, is properly protected against perils like fire, natural disasters, or major liability claims. Insufficient master coverage puts the entire project, and thus every individual unit within it, at a significantly higher risk. Common coverage gaps in HO6 policies that condo owners often overlook include underestimating the cost to rebuild the interior of their unit, especially if they have high-end finishes or made significant upgrades, or having insufficient loss assessment coverage. Loss assessment coverage is a crucial add-on to your HO6 that protects you if the master policy is insufficient and a special assessment is levied against owners to cover that gap.
So it's insurance against the master policy not being enough.
Basically, yes. Without it, you could be on the hook for tens of thousands of dollars out of pocket after a major insurable loan hits the building. So for you, this means understanding that the condo's insurance isn't just some detail for the association to worry about, it's a direct prerequisite for your loan. You'll need to confirm its adequacy alongside securing your own HO6 policy, tailored precisely to what the master policy doesn't cover.
So, okay, what does this all mean after such a comprehensive exploration? We've really unpacked how financing a condo is, well, a totally different ballgame than securing a mortgage for a single-family home. It's a journey filled with unique considerations that, if you overlook them, can lead to significant delays, unexpected costs, or maybe even outright disqualification for a loan. We started by understanding that lenders look well beyond just your individual creditworthiness. They cast this broader, scrutinizing lens on the entire condo association's financial health, its reserves, its occupancy rates, any looming litigation. Then we navigated the specific hurdles and loan program eligibility, discovering that your options might be profoundly limited if the condo isn't FHA or VA approved, or if it triggers that stringent full project review for conventional loans. We saw how these factors can translate into tangible financial impacts for you, from potentially higher interest rates and larger down payment requirements to the significant ongoing consideration of mandatory HOA fees and the ever-present risk of those dreaded special assessments. And finally, we clarified the unique two-tiered insurance structure where your HO6 policy works in critical conjunction with the association's master policy to truly protect your investment. Our goal today was really to give you that shortcut to being truly well-informed, to provide those aha moments that transform maybe vague assumptions into clear, actionable understanding. Knowing these crucial differences up front is, I think, your invaluable superpower here. It helps you avoid frustrating delays, potentially save money by finding the right project that is well managed and warrantable, and ultimately secure the best loan option for your needs, ensuring your condo purchase is a smooth and confident step forward. This knowledge is kind of your shield in what can often feel like a complex financial labyrinth.
If we connect all these threads to the bigger picture, yeah, the key takeaway is profoundly simple yet critically important. Buying a condo means truly buying into a community and its collective financial health. Your personal financial future in this scenario isn't just about your income or your credit score, it's intricately intertwined with the strength, stability, and responsible management of the condo association itself. You're not just purchasing a unit, you're essentially becoming a shareholder in a collective entity where the actions and financial health of that collective directly impact your individual investment. This raises, I think, an important question for you to ponder long after this deep dive concludes. Given this shared ownership and interconnected financial health, how much due diligence should you truly invest? Not just in inspecting your individual unit, but in scrutinizing the entire condo association's governance, its financial records, its long-term planning, its reserve study, its meeting minutes, and its management track record, before making such a significant and interconnected commitment. It's a level of inquiry that goes far beyond what a typical single-family home buyer would ever undertake, but one that is absolutely essential for confident, long-term condo ownership.